Good morning, everybody, or good afternoon if you're on the East Coast. It's good to have you today. I'm here today with my dear friend and colleague on the NAHREP National Board, Jerry Ascencio, and I'm excited about the presentation that we have for everybody today. Let me kind of start, Jerry, if you don't mind, by giving a little bit of context and kind of setting up what the conversation today is going to be all about. But, this is really an exciting moment for us and place where we are with respect to the Hispanic Wealth Project. As you know, back in 2014, we launched the Hispanic Wealth Project with a goal to triple Latino household wealth over a 10-year span. And the thrust behind it was really motivated by what we saw happen to Latino household wealth to 2000 Great Recession. And during that period of time, we saw that Hispanic household wealth dropped by as much as 2/3. We lost 2/3 of our median household wealth during that period of time. And it was disproportionate to what the rest of the country was experiencing. We got hit harder than any other segment of the population. And in a conversation that I had with Henry Cisneros, we recognized that NAHREP was in a unique position to provide some leadership to address this issue for two reasons. One, if you look at the primary source of household wealth for most families in this country, especially Latinos, we know that home equity is the #1 source of wealth for our community. And we're an organization that's all about advancing sustainable Hispanic home ownership. But a secondary important source of wealth for Latinos in particular is business ownership, small business ownership. And we are a network of real estate practitioners who are largely independent contractors and small business owners. So that really put us in a unique position to provide, as I described, leadership in this area. And if you remember, Jerry, we drafted that blueprint back in 2014, which really laid out what we thought it would take to triple Latino household wealth over a 10-year span. And there were 3 buckets that we said we can focus on. #1, of course, advancing the goal of sustainable Hispanic home ownership and reaching a 50% threshold, which we're very close to reaching right now, which is a tipping point for us in terms of wealth creation. The second is to help our small business members, the ones that own small businesses, scale their businesses. Latinos are prolific at starting small businesses, but those small businesses tend to be small and stay small. And so we've had very few of those companies become big companies. And we've partnered with the Stanford Latino Entrepreneurship Initiative to provide some content and educational content and how our members can scale their companies, turn a successful small business into a medium-sized or a large business over time. Big, big goal, big opportunity. We're going to talk a lot more about that in the future. But the third one, which really relates to this presentation today, is the diversifying our wealth and being more focused on what we call non-cash financial assets. One of the reasons that we were disproportionately hit during the crisis is because we weren't diversified enough. And during that stretch of time, real estate valuations and the real estate market in general was decimated. And as you remember, there was tons of foreclosures and short sales, and people's valuations of those properties were going way down. And because we didn't have anything else to fall back onto, such as investments in stocks and stock-based investment products and index funds and so forth, we got hit harder than anybody else. So one of the great things that we have within NAHREP is the fact that our network is made up of influencers. These are not just people who facilitate real estate transactions. These are trusted advisors in those communities. So if we can improve the skill sets and the disciplines of our influencer network, then the cascading effect that can have in Hispanic communities throughout the nation can be profound. So we're following through on that by providing our members with information and resources about investing in these non-cash financial assets. And that's what today's all about.
Beautiful. And I couldn't agree with you more, Gary. I mean, myself, the one passion I have, the one area I know is real estate. So my investments and my holdings and my assets are all real estate related. I want to be able to walk over to it, touch it, visit it, all this kind of stuff. So this for me, And for many people that are probably watching this webinar right now, is an expansion, is diversifying, maybe for the very first time. So I'd like to start out and open up this deck. We have a wonderful deck, a great amount of information that we want to share. And I'd want to open up with this. If this is new to you, this is exactly where you need to be, because you are probably, maybe like myself, a real estate entrepreneur, a person that's been in the business 30 years, a broker owner, a real estate investor of sorts, and maybe now you're ready to take it to another area, which is now the stock market. But then that begs the question, Gary, where do we start? How do we do it, etc. So
yeah, for a lot of people, Jerry, as you know, it's a very intimidating process. We understand real estate. We understand the tangibility of it, as you said, the fact that real estate has utility, right? People can live in it, and we know what to do with real estate. Stocks tend to be a little bit more esoteric. They be a little bit more intimidating because it's a complicated sort of concept to understand, but it doesn't have to be. And so this particular presentation is designed for people who are ready to take that step, like you did recently.
Yes. I'll share my own story. And by the way, I'm learning this as we go here. And so I'm really excited to deliver these basics over to you. With that, let's start with that first page. Let's go to the next page on the slide. So Gary, I understand now that there are retirement accounts, which I think they should be called investment accounts or stock-based investment accounts, because the whole retirement thing for our new people, for our youth and everything else, they think, well, that's going to be like, 30, 40 years from now, et cetera. So there's that category there. Then there's the brokerage accounts, private investment accounts, where you hold your money to be able to buy stocks and that kind of thing. And then there's the other part, the college savings plans, which I just recently, after going through this with NAHREP and with our leadership team, Noelena and Jamie and yourself, that's when I actually realized that my 529 plan, my college savings plan, was actually a stock-based investment plan as well. And I didn't even realize that that's the way that worked. And then finally, health savings plans, things that we need to prepare for, long-term care, all these other kind of things. But if you put these in these 4 quadrants, Gary, where does one start? And what is the difference between one over the other? And to our general people that are out there, our general practitioners, our successful entrepreneurs that have a little bit of assets, where do they begin? Take us through this slide, if you will, please.
Well, I'll just give some brief comments. And these are, I think, 4 categories of investment products or platforms that can be leveraged. The brokerage accounts are the accounts that I think most people are familiar with, right? You open up a brokerage account, you can use that money to invest in individual stocks, or you can use it to invest in mutual funds or index funds. And these are investment opportunities where they pool a bunch of stocks together. And that sort of also creates this diversification effect that makes it a lot less risky. When you invest in individual stocks, the upside can be greater, but the risk is greater, because if that individual company has, some challenges, that stock price can go down, and therefore your investment is, at risk at that point. The other 3 are all unique platforms to be able to invest in stocks and bonds and so forth, but they have both benefits and limitations associated with them. The federal government has a motivation to want to get us to invest in our own retirement, because the government doesn't want to be responsible for having to support us in our old age, basically. So they've created tax incentives to invest in a retirement account, for example. They will say, depending on the vehicle that you use, that you may not be taxed on the money that you push into your retirement account at this time. So you get to invest that money before it is taxed, and then it can then grow inside that investment vehicle without being taxed along the way, even though you might have dividends and other things that would typically be taxed if it were held in a brokerage account. This is really, really important. Of course, the trade-off for investing in a retirement account is you can't touch that money until you reach retirement age, right? So, if you're looking at it as a source of liquidity for yourself, it's not the way you want to go. But depending on what tax bracket you're in, you can conceivably invest into a retirement account. Let's just say that you make, $80,000 a year and you're taxed at a 20%, federal tax rate. If you actually take $5,000 of that 80,000 and invest it into an IRA, the reduction that you get in taxes can actually offset the amount of money that you're directing into that investment. In other words, your net after taxes, what you take home may not be affected at all. You may actually net the same because of that reduced tax burden that you have by pushing that money into that. I know that sounds a little bit complicated, but the point I'm trying to make is that retirement accounts are almost the no-brainer of the four.
Mm-hmm.
Like, take some of your money, put it in there, take advantage of the tax savings that it provides you with, and forget about it, because down the line, it's going to be worth a lot to you and your family.
Got it. Got it. Let's move to the next slide, because let's take a little bit of a deeper dive into the retirement accounts. I mean, we understand that it provides a tax advantage. That's huge, because we all want to pay the minimum amount of tax. And if we can leverage, use that money rather than hand it over to the government. I just got done reading. I love David Bach's presentation at NAHREP at Latitude. And I just got done reading his Automatic Millionaire book. And that's one of the first thing he says, before you pay anybody else, something that I had already read in The Richest Man in Babylon, pay yourself first. And there he includes pay yourself first, even before paying the government. So this provides a tax advantage either right now or later on. Now, we understand that it's usually done through the employer or through a bank, etc. But then they turn around and they use that money to be able to buy stocks, bonds, and mutual funds, et cetera, et cetera. And the idea is to put it in there and not withdraw it until you're 59 and a half years of age to avoid the 10% penalty. What would you say to our young guns, our millennials, everyone that's thinking, well, wait a minute, I'm 25, I'm 30 years old. How am I going to be thinking about 59 and a half years old? What would you say to that, Gary?
Well, I would say this, right? Almost any schedule that you'll see in terms of what is likely to be there for you when you reach retirement indicates that it's not how much you contribute into these retirement accounts, it's how long you do. So those that start in their 20s are going to have to contribute a lot less towards this to be able to achieve the same amount of money than somebody who would start later. And if you understand the concept of compound interest, you'd recognize how that's true. So even if you're putting $1,000 a year into your retirement account when you're in your 20s, which is nothing, I don't care, how little you make, $1,000 a year should be a drop in the bucket. The payoff for that down the line is going to be tremendous, right? We got to start thinking long-term and stop thinking about just tomorrow.
Beautiful. Let's take a little bit of a deeper dive. Let's go to the next slide here, where we compare the 401k to the individual retirement account, the IRA, and the limitations, the pros and cons of these two. One that is employer sponsored, more for the W-2 type of person, et cetera, and the other that is more of a private account that is not done through the employer. Now, I see here that there's that difference between the traditional IRA and then the Roth IRA, which is, pre or post taxes. Take us a little bit there. I mean, which one would you recommend? And give me a scenario of someone, maybe even in your own family, Gary, where one would be more beneficial over the other for learning purposes for our audience.
Well, obviously, there's limitations on the IRA accounts that are more significant. So 6,000 is the limit, whereas with a 401k, you can invest a little bit more. The difference between pre-tax and post-tax is one where your investment then is either taxed today, and then you make the net, you take out of your net check what you want to invest, but then you don't pay taxes when you withdraw down the line. Whereas pre-tax, you take that money before it's taxed, you put it into the investment account, and you don't pay taxes while it's accumulating, dividends and interest and so forth, but you do pay taxes when it's withdrawn down the line, right? So you have a limitation on how much you can do pre-tax. You have a greater capacity to invest more on the post-tax pieces of that. So if you work for a company that matches your 401k, you can't not take advantage of that. I mean, that is free money that is available to you that if you don't take advantage of, you're just making a huge mistake. So you make your investment, your employer matches that investment. If you do the math, the return on that investment is exponentially greater.
Beautiful. And that's for our W-2 people. But what happens now, Gary, some of our LOs here in the state of California are no longer 1099. They're actually paid on a W-2. Would they fall into this bucket, or would they be for the self-employed 1099 type of product?
Well, if they take a wage, a W-2 wage, regardless of it's commission-based or not, then they wouldn't necessarily be eligible for a SEP IRA, at least as far as I know. SEP IRAs, and I think that's the next slide, are specifically for self-employed individuals. And there's tremendous opportunities there. And if you can see from the slide here, the max contribution is much greater.
So this SEP IRA or these accounts for the self-employed represent more like myself, a real estate broker, a 1099, self-employed, etc. And these are very tax advantaged, etc. And we can put bigger money into it. Wouldn't another way to, I see that there are contribution limits depending upon the income. What if we're talking about a real estate agent? It's their first year in real estate. They've sold a couple of homes. Maybe their income is starting out at a modest $35,000, $40,000, $50,000. How much of that can they throw into a SEP IRA or a solo 401k or even an IRA for the self-employed?
If you look at the NAHREP 10 principles, we recommend that people pay 20% or take 20% of their income and invest it in real estate and stocks. I would caveat that by saying the first thing you should do with your income or your excess income is pay down any debt that you might have. So you have credit card debt or even auto debt, probably want to pay that first because the interest that you're paying is probably greater than the likely return that you're going to get on a typical investment. But beyond that, your goal should be to direct 20% of the money that you earn towards an investment in either one of these that we're discussing here, or perhaps a piece of real estate. That's my recommendation. It may take you a little time to get there, but when you're young, Jerry, it also means you typically don't have the expenses that people who are older tend to have, right? You may not have children yet. You may not have the types of expenses that you would typically have when you're older. So it's even a greater opportunity to take advantage of some of these investment opportunities.
Okay. Well, Gary, I think that for some of our participants out there and members at large, this all kind of sounds like alphabet soup. SEPIRARESPECT401k. It sounds very confusing. So let's go back to some of the fundamentals on the next slide where we compare the traditional IRA with a Roth IRA and who exactly it's designed for. I mean, we see here that on the traditional ones, it's made with pre-tax dollars. We like that, because we'd rather deduct it, off that top line revenue and pay less money to Uncle Sam. And so that seems to me, very attractive. Versus on the Roth IRA, it's after after your take home pay. So give me two scenarios on somebody that is more of a traditional IRA candidate versus somebody that may be watching this webinar right now, where the Roth IRA is more suited for them.
Well, I think you think about it in these terms, Jerry. The tax bracket that you're in at this point is probably higher than the tax bracket that you're going to be in when you retire, right? So you want to contribute necessarily at a higher tax bracket, so then when you withdraw, you can get it at a lower tax bracket. So that the traditional actually makes sense for that type of scenario, right? The Roth, I think, provides the opportunity to invest more. So the government says there's limitations on how much we're going to let you invest into a retirement account if you're going to do it pre-tax, where the Roth now allows you to go into greater numbers. You can invest more into it. You got to pay taxes on it now, but when you take it out, you don't have to pay taxes on it then.
One of the things that caught my attention, Gary, was that minimum distributions after the age of 72. It almost sounds like at the age of 72 on the traditional IRA, they want you to pull your money out. What is that? How's that structured? Give me some logic behind that.
Well, there is, some of these investment vehicles require you to withdraw the money at a, in particular time. Now, the earlier you take it out, the more that you tend to pay in terms of taxes and other potential expenses. The later that you wait, the more that you can take out without paying as much taxes and paying as much or any fees as well. So again, the longer that you can wait to take that distribution, the better it is for you typically from a tax standpoint. It also allows you to accumulate more money during that period of time. So it all depends on your situation in life, really, which works best for you. It's hard for us to know what's going to happen 30 years from now, but it's good for us to have maybe investments in both sometimes, because we can then sort of tweak the distribution that best accommodates our situation at that time.
So what I hear you saying is that maybe we can have a series of investment accounts, not only one, even diversifying within the investment vehicles that we're presenting today, not put everything all in one basket, because there is not a one size fits all.
Yeah, there's also, and Jamie's pointing out that there's income limitations that one might have over another. And so depending on how much you earn now, there may be more limitations on what you can put into a retirement account.
Got it. Perfect. Now, I love the next slide that we're going to share, Gary, because basically in this one, we kind of paint a picture, or what you would probably call a blueprint, as to where do we start. And it starts with employer-sponsored 401ks. You've already told us that. I mean, it's a no-brainer, etc. Seeing if our employer has one, participate in it. Somebody already did the legwork. Somebody already created it. They set it up as an employee benefit for you. Why not jump into it? Then the next part that we touched on was the employer match. And of course, that's free money. So if your employer is going to match, now on those matches, with what you've seen, Gary, are those dollar for dollar, or how do those matches work on some of these large companies that do the employer match?
Yeah, most that I've seen, there is a dollar for dollar match, but there's a cap typically. So there may be a dollar cap, or there may be a percentage cap. So every employer is a little bit different, but that's typically how they work.
Got it. The next part that we go into there is doing that side-by-side comparison. And by the way, this beautiful PowerPoint that you're seeing, this deck, is going to be available. This is going to be a resource that we're going to invite you to look back on, because maybe some of you, like me, heard this for the very first time and thought, oh my goodness, what are all these acronyms all about? You need to go back, digest it slowly, take a look at how it applies to you, take a look at your age, etc. That third step there, deciding if are you a good fit for a traditional or a Roth IRA, and seeing which of those two is better for you. Then we talk about the increased contributions into it, which are based on the goal. Now, Gary, take me to the goal, because we really hadn't spoken about what the goal, what is the end result, or what is the end goal? Are we going to start with that end goal in mind? And how do we reverse engineer that number? What is that going to look like? Because how can we select the path if we don't know exactly what the destination is going to be, Gary?
Well, as you know, as you know, Jerry, we set a goal in tandem with the Hispanic Wealth Project to create 1,000 NAHREP millionaires, right? Now that's a sort of arbitrary milestone, and $1 million today isn't what $1 million was 10 or 20 years ago, but it's a great threshold for us all to be, aiming towards. And when I say a millionaire, I don't necessarily mean somebody who maybe has, equity in their home, or, equity in their businesses per se. I'm speaking particularly about a person who has $1 million of investment capital available to them, liquid, right? $1 million liquid. That in itself probably won't be enough, frankly, to finance your retirement, but it is a very good sort of milestone to aim towards. It'll probably require a couple $1 million, frankly, in investment capital to be able to fund a healthy and comfortable retirement. But those are the goals that we should be looking at. There should be, to your point, an end game that we're moving towards, and you can play with the math a little bit and see what it takes in the way of contributions to be able to meet that goal.
Got it. And by the way, we are going to take questions once we get through this initial information. I love the way David Bach put it, and he said, creating a 7-figure net worth. I like that. Sometimes it's not easy to say, I want to be a millionaire. That doesn't roll off the Latino tongue like that. I mean, we didn't wake up in the morning and say, hey, I want to be a millionaire. But creating a 7-figure net worth, that's digestible. That's something that we can chip away at.
Yeah,
And of course,
I mean, I think that one of the things as Latinos, we have to become a little less shy about our intention to build wealth and create wealth for ourselves and our family. As long as we understand, Jerry, that wealth, again, is not just about superficial things, about the ability to buy things that we don't need. Wealth is about freedom. Wealth is about creating an environment where ourselves and our children can live the lives that they're destined to live. I've said that many, many times. So let's not make wealth a bad word. Let's not make being a millionaire sort of, something that we shy away from. We should embrace it, but embrace it in the right way.
Embrace it in the right way. You're right. And we're looking for the creation for 1,000 new Latino millionaires. I mean, that's exciting, guys. If you're listening to this, I'm referring to you. As we go into the fifth part of this, I love this slide, by the way, this particular slide. We look into additional investment opportunities. So it doesn't stop with the retirement accounts. Then we go into other things like taxable accounts, brokerage accounts, college savings plans, and other health savings type of instruments. Let's go into brokerage accounts for a minute, if we will, Gary. They're open through the bank. They're open through financial institutions. They're used to buy securities, stocks, bonds, mutual funds. There's a lot of that activity online where people are buying, people are selling. We'll get a little bit deeper into that. But start us off on brokerage account. The first thing that comes to my mind when you say brokerage is a real estate brokerage like the one I own. But here we're changing to a completely different model. So take us to these brokerage accounts.
Brokerage accounts, I think, are what most people think about when they think about the stock market, frankly. And to outside of the real estate industry, brokerage accounts are generally understood as this, right? A place that you go and you're able to buy stocks and bonds and index funds and mutual funds and that sort of thing. The advantage and disadvantage of the brokerage account versus retirement accounts, and I think you should do both, frankly. I think you should have a retirement account and take advantage of the tax benefits that go along with that. But a brokerage account provides you with liquidity. And I think that it not only, when I say liquidity, is when you make an investment in a brokerage account, you can withdraw that money at any time. You can liquidate those stocks, which you can generally do in a matter of a couple of days, and you can withdraw that money if you need it because you have an emergency or you want to make an investment, you want to buy a second home or something like that. It's a liquid asset that you can withdraw. And it's actually more liquid than real estate itself, right? So it's one of the reasons why I think we were disproportionately hit through the housing crisis was that we didn't have enough money in liquid type investments like this to be able to help us offset a difficult time that we may have been going through during that crisis between 2008 and 2012. So a brokerage account is a vehicle, or it provides us with a vehicle to be able to invest in individual stocks or index funds or bonds per se, but also does not have any tax advantages. So therefore, we're able to withdraw it and make investments at will without any tax consequences.
Got it. Let's go to the next slide there, because this is going to actually show us those key differences. First, we talk about the access to fund. It can be sold at any time. You've already spoken to us about that. On the tax liability, you can't write it off. Not because you buy a stock through your brokerage account is that going to be a line item that you put on that tax return. And then, of course, it's open to basically unlimited options of where you want to invest, buying individual stocks or that kind of things. A lot less restrictions. than all those other things. So these are the things that you've covered for us. And you're probably right. For the mainstream America, brokerage, when they say brokerage, it probably means more of this space, Gary, versus we that are brokers in real estate. So anything else that you want to point out here on these differences as we dive into the brokerage account option, which would be that fifth piece of the blueprint?
Yeah, not in particular, Jerry. Let me just caveat by the fact that if you withdraw money from your brokerage account that has received dividends, some of those dividends may be taxable. So I'm not saying that this is a tax exempt type situation, but there's no penalties when you withdraw this money as there is with 401ks and retirement accounts.
Got it. Beautiful. And then we go to another two categories, which is the college savings plan, the 529. For me, it was very interesting. This is a great NAHREP story because one of the former past chapter presidents that worked and represented a certain company presented me with the idea of putting a 529 together. And I said, sure, we'll throw, a couple, bucks into it every month. And I've seen the way it has accumulated and it has grown over the years. And I didn't even feel it. I didn't even remember that I had it. And it wasn't until I spoke to Lorena, yourself, and the national team that I realized that this college savings plan, the 529, is also for this type of stock-based investment. For me, I just didn't put two and two together. For me, I was just putting away for college, for my kids, for little Jerry, Alex, and Adrian to one day go to private school or whatever else, etc. But I saw that now the benefit, looking back at it, seeing it grow. I mean, it's really a convenient way to set some money aside for the college for the kids. What can you add to that?
No, I think that's right. I didn't do that, frankly, and I regret it. I didn't take advantage of, the, tax savings that I could have realized. I ended up having, all three kids attend private colleges, which was really expensive. And there are, vehicles to help offset those costs and help us, not only create a process where the investment is automatic, but also there's tax savings associated with that. So again, these are products out there that the rest of the world seems to know exist, but for whatever reason, as Latinos, we've become, less aware of them, and we've got to change that.
Got it. And the fourth category there, that fourth quadrant that we started with at the beginning, Gary, health savings plan. That one is the one that kind of took me for a turn there because I thought, wait a minute, those usually are not involved in the same sentence. I mean, one thing is a health plan, the other is the savings plan. Can you connect the dots for us there on the health savings plan?
Yeah, and this is something I do participate in, right? So a portion of my check then goes into a health savings plan. And, when we have insurance, most of us have deductibles associated with the insurance, and some things aren't insured necessarily. And you can use this money, which is pre-tax also, to pay for those deductibles and then, offset those costs. So where, when you have a situation where you need medical care for yourself or your family, it doesn't necessarily impact you in the same way. It provides you with a vehicle to be able to save for those unexpected emergencies. So it's a little lesser known even than the college savings plan investment opportunity that, I've been taking advantage of for the last 5 or 6 years. And, we've used it and it carries over if you don't use it. And it's just there to help you offset those unexpected medical costs.
Beautiful. And one of the things that we envisioned during this presentation, more than an educational presentation, more than just watching all the stats and the beautiful graphics, we're wanting people and inviting them and challenging them to step up and take action. So as we go to the next slide, where do we start? So I think that the first thing that we need to take a look at for those that have an employer, I am my own employer, but those that have an employer, look there because it's the easiest way to open it up through the 401ks, through the HSAs, etc. Take a look at those matching contributions that are done, etc. So that's probably the no-brainer. And number two, today, There's a lot of this that's available online. And by the way, we're going to share a bunch of resources at the end of this deck where you can jump online and just, you can invest, you can open up an online brokerage, an IRA, college savings account, or an HSA in just a matter of minutes. Everything can be done without ever actually walking into a brick and mortar type of organization. And then, of course, the college savings plan number 3 that are operated by the states that are also offer some tax incentives, etc., depending upon where people are living. So would you agree, Gary, that these are kind of the 3 steps where people would start? Anything, any particular instructions that you want to give in terms of these 3?
Yeah, no, I think that's right. First of all, if your employer offers a 401k and provides matching in particular, even if it doesn't, but if it does, you certainly want to start there and take advantage of that opportunity, because there's probably nothing that's going to beat that investment. And then, as you said, there's other places that we're going to direct them to in a second or two, where they can open up either brokerage accounts or retirement accounts on their own.
So the big question there goes, now that we know what we're kind of wanting us, what is the ask for us? The next thing is, are you going to do it yourself, hands-on, or are you more of the set it and forget it? Let's go to the hands-on investor. That would be the next slide, where we want to choose, we want to control our own investments. And maybe it's a person, Gary, that feels comfortable researching the tax implications of what we're doing. We've done a lot of research on that. We've read up on that. We hear a lot about the self-service brokerage firms. Some of them require a minimum, almost zero balance, minimum or no fees on the trades, those kind of things, etc. So this is for the hands-on investor. So describe who this would apply to, who has the type of savvy experience to make the right choices and do this all by themselves without professional help.
I think if you're an individual that wants to do the research into individual investment opportunities, such as individual stocks or even mutual funds, or you're the type of person that says, I'm going to put my money into an index fund, which is, as I think I said before, a fund that pools a lot of stocks under one particular investment vehicle that has a much more diversified scenario, where there's a lot of people who invest in index funds. You're basically investing in the entire stock market or the entire Dow Jones or the S&P 500 collectively. Those are usually pretty safe investments. So if you want to just put it in one of those and forget about it, then you can do it yourself. You should probably open up an Ameritrade or E-Trade type account, and the fees associated with that are minimal. And you can put your money in those either index funds, or, like I said, if you want to do the work and invest, really research these companies and then determine for yourself which ones that you want to invest in, that's probably the way to go.
Awesome. That reminds me, I have a general manager. His name is Raul Chavez. And sometimes I hear him in the corner of the office there yell, ah, my stocks did amazing. And sometimes I hear him crying and he's a little bit quiet. So it's a little bit about the ups. And that would make me very uneasy, Gary. I would go to the next slide and say that I'm more of a candidate for a hands-off type of investor. The same way that I wouldn't recommend that somebody go FSBO, for sale by owner. I would say, no, Mr. For sale by owner, leave it in the hands of the trusted professional. Yes, there are some fees involved, and my real estate commission, my brokerage commission is very, very well invested, because I'm going to get you the best representation. I'll help you make the best choices. You can just relax and have your evening coffee while I'm out there marketing, doing everything for your house. That to me sounds like the hands-off investor option that I would prefer in terms of investing there. I would prefer to have a professional control the investments and rebalance the portfolio for you, because I'm busy running a company. I'm busy being a father. I'm busy being a husband. I'm busy doing all these great things, working for my community, in my parish, all these things. I would rather rely on somebody else. And I certainly am not a tax specialist where I would want to be doing the deep research as to, if I do this, which way am I going to pay more or less taxes? For me, a full service brokerage is probably more suited to that. And for that, I know that you're going to announce the official partnership with NAHREP and Morgan Stanley.
Yeah, we do have a partnership with Morgan Stanley, Jerry. And let me just kind of, expand a little bit on your comments around, having a full service relationship versus not. The other positive, quite frankly, is that is that there's a certain degree of responsibility and liability that I feel as a steward for NAHREP in particular, right? So I don't want the responsibility of making or investing the retirement accounts of our employees, right? So we're going to hand that off to experts who do this for a living, essentially, and a very reputable one, right? I also, have to make a decision as the CEO of NAHREP as where to put our capital reserves as well, right? And I don't want the responsibility of picking individual stocks or investments for NAHREP in particular, right? So I'm going to hand that off to Morgan Stanley, and they're going to do the work that's necessary to investigate the right investments and so forth. So it's not just about whether or not you want to do the research or feel that you can. It's also, there's liability especially when you're dealing with other people's money. You got to be very, very careful around. There's a lot of shady brokers out there. Let's not shy away from that either. So I prefer to work with one of the most reputable firms that exist in the country, which is Morgan Stanley. And there are others, and they are certainly not the only one. There's Goldman Sachs, there's Schwab, who's also a sponsor of NAHREP. They're very reputable companies, and all of them do great work. But I certainly am not the type of person that wants to be sitting around choosing individual stocks. I might do it for fun, for just a few stocks. I get my my fill. Being an entrepreneur myself, I feel like I have enough risk. And there's enough adrenaline in what I do. I don't need to also be in the business of selecting stocks and dealing with the volatility that might exist with that. So yes, we definitely encourage people who don't want to take on that responsibility, don't want to expose themselves in terms of liability. And those of us that just prefer to leave this in the hand of experts, while I get to do what I do best, let them do what they do best. This is certainly, a different way to go.
Absolutely. And, for me, this morning, I said to you, Gary, I want to open up a new IRA account. And all it took was one call. I called sent an email to James Cotto at Morgan Stanley and his team. And inside of 30 minutes, somebody was already emailing me back. We were on the phone, a 2-page PDF, boom, and opened the account just like that. For me, previous to this relationship or previous to this partnership, I heard that the words Morgan Stanley. I thought, well, that's for the very rich, affluent people that have billions and billions of dollars. But no, I don't think that there's anything further from the truth. They're very accessible, very friendly, and they are very service oriented to try to make this as easy
They're
as
smart
possible.
too. They're smart. We put, as you know, Jerry, being a member of the NAHREP board, we put in money in Morgan Stanley at the beginning of the year, and right early on the year when the pandemic first started. If you remember, the stock market crashed at that period of time, and they were able to maneuver through that so seamlessly. We lost no money when the market was going down because he was already sort of anticipating that for us. So there is real expertise that's out there for people who look at these charts every day and make intelligent decisions. It's not guaranteed, but they're probably a lot better at it than I am.
Got it. And as we go to the next slide, we're reminded that actually NAHREP discipline number 5 reminds us that we need to invest 20% of our income in real estate and in stocks, because those are the best and safest ways to build wealth. And we've gone around the country, we've told people about that. But as it's mentioned here, 20% is just a ballpark. You can invest more. If you're not at 20% and you don't feel comfortable with that yet, you can start small. Part of David Bach's book, Automatic Millionaire, spoke about people that started investing 4%, then went to 5%, and then moved slowly to 10% of their income paying themselves first. So, but let's go to the next slide as we now, talk about how do we choose our investments? What are the things that we need to consider? Well, certainly, Gary, you've already talked about when are you going to need these funds? Do you need them today? Is liquidity, something that you need? Do you need to pull back those funds for an emergency? That kind of thing. The costs that are there, what it costs to, have these online accounts, the low fee versus the full service. And then, what's your appetite for risk and what's your particular investment style? What words of wisdom would you give, Gary, to the people that are listening to us? I mean, I see AT here on the chat box in Dallas. To people across the country, what would you tell them on how to choose maybe their first investments outside of the real estate space?
Well, first of all, I think we've said it already. If you are not taking advantage of a retirement account, that's probably where you want to start. The amount of money that you can invest into a retirement account, whether it's a IRA or a 401k or a SEP IRA, might depend on your current financial situation. And you have to make that determination for yourself, right? I have no problem putting $5,000 away into one of these, accounts for during the course of the year. But I need to, have some liquidity. I'm self-employed. Every so often, there's ups and downs in our business, and I need to be able to know that that money is accessible to me if I need it. And that's like I said, a calculation that you can make for yourself. Nothing wrong with keeping money in cash, but as if you put money in cash, it's actually losing value every year because of inflation. So you want to make an investment that at least keeps up with inflation and hopefully a little bit more. And we want to make these vehicles become less intimidating to our community, to our network. And I don't mean that in a negative way. It sounds complicated. Sounds like I need a whole lot of expertise to be able to do this. It's really not that complicated. It doesn't require that, that much expertise. There's a lot of resources out there to help us go through the process. The thing that I really want to emphasize more than anything else, Jerry, is that as a community, Latinos have a worker's mentality, which is beautiful, right? We come to this country to work, right? We roll up our sleeves and we get to work. What we don't have historically is an investor's mentality, right? There's a worker's mentality and there's an investor's mentality, right? We need a little bit less of the worker's mentality and a little bit more of the investor's mentality, because that's what's going to create long-term generational wealth for ourselves and our families.
So one of the big takeaways for today, NAHREP familia that are listening to us across the nation, we have to stop working for money and start having money work for us.
Yes.
The investor's mentality. So, but now let's talk about a big word that we haven't really touched on, and that is the word risk. As we go into the next slide here, I want to understand the investment risk that's involved. You talked about cash, a bank deposit, a gun safe back at the house full of $100 bills, Benjamin Franklin's, and all the way through cash, bonds, pooled investments, and stocks. The lowest risk being the cash over on the left, the highest risks being the stocks over on the right. But then the relationship, the direct relationship between the potential yield of the lowest risk being lower potential yield and the highest risks investments being the highest potential yield. What's a good balance? How does one throw some one way versus the other?
Well, Jerry, like you said, if you have money in cash and you have it in a bank that's insured by the FDIC, that's as safe as you can get in terms of where your money is going to be. You're not going to lose value. That money is not going to go away. Bonds are government guaranteed investment vehicles like treasury bonds. We're familiar with those. Those are guaranteed by the full faith of the United States government. almost as risk-free as cash, right? I mean, there's, I guess, a 1 in a million chance the United States can go bankrupt, but it's a pretty slim chance. The next would be pooled investments. And so these are investments in stocks, but they're done in a sort of pooled way. So you're not investing in an individual stock, you're investing in a pool of stocks, which creates this diversification effect and lowers the risk, right? So one stock might go up, one stock may go down because of, something that's happening to their sector, right? So, right now hotels are not doing well, financially, but tech is doing really well. Finance is doing really well. So if you have your investments spread over kind of the breadth of our economy, you're going to have less risk by that diversification. The most risky is individual stocks. So I'm selecting individual stocks. If I do that, the potential could be great. I'm not sure what's happening to our slides here, but maybe they're telling us that we're falling behind. But
there's a lot of information, Gary.
Yeah, it could be great. If you remember when I did that series on the NAHREP 10 principles, I gave this specific story on how I had bought my wife a $10,000 gift to celebrate our 10-year anniversary. And I had said, had I not done that and instead gave her $10,000 worth of Apple stock, today that would be worth more than $2 million, right? So there could be much great upside if you pick the right stocks, but also, you potentially could have been, invested in Wang Computers at that time, which is now bankrupt, and that money could have been lost altogether. So individual stocks have the potential for great upside, but also contain the most risk.
Awesome. And based on that, I'm proud to tell you, my son Adrian, at the age of 19, already bought his first share of Amazon stock, and he was proudly telling me that this week. So he's stepping up with the big boys. That's a good thing.
One of the things that I know, our friends from Morgan Stanley, James said in particular, is that sometimes if there's a particular product that you use a lot, whether it's Amazon or Apple or Zoom or some of the Sephora that's listed here on the screen, you're contributing towards building the wealth of that corporation. You can actually benefit from that by owning stock in that individual. So some people do it that way. They invest in companies that they use because it's an interesting dynamic that's created.
Beautiful. I want to share these 3 strategies with everyone, Gary, and that is being patient and thinking long term. So what we are not saying here is that this is some kind of get rich quick, Dave Delgado, come to my seminar kind of scheme, right? I mean, compare those things to more of a long-term.
I haven't heard that name in a long time, Jerry.
Late night TV back in the 1980s and 90s, yes. And then what about keeping the emotions under control? I was telling you about my office manager, Don Raul. He's a wonderful guy. Gets very, very excited on great days when his particular stocks that he invests in, he invests in individual stocks. When they do well, he's having a fabulous day. He's jumping up and down. And then when things happen in those companies or in those particular entities, he's kind of having a dry day. So, but I also want to talk about the timing of the market. That's a huge thing. People are asking themselves, when is a good time to start, Gary? Do I wait until after the election? Well, the election is kind of over, I guess. Do I wait until after the new administration takes charge? Do I wait until the new year? Is there a good time or a bad time in the calendar year to buy and invest in stock or in any one of the other vehicles? What are your thoughts on that?
Well, just real quick, Jerry, I do think that it's always dangerous to try to time the market. Warren Buffett, who is probably the most sophisticated investor in our lifetime, says he never tries to time the market. He just looks for good investments that over time are going to provide a great return. I think that's always the best mindset to have. When markets are going down, we have a tendency to think, oh my God, the stock market just lost 2,000 points. Is now a good time to buy? Well, it could be, but somebody sort of compared that to trying to catch a falling knife. right? You never know where bottom is. And then conversely, when prices are going up, we think that they're always going to go up, and they don't always, perform that way. So just like a piece of real estate, Jerry, right? You own a piece of real estate, you're not looking every day on Zillow to see, has the price of that home or the value of that home gone up, between yesterday and today? You may look at it once a year, you may look at it, once every 6 months, but you don't think about it in those terms. I think that that's a healthy way to approach stocks as well. You own a piece of that company. If that company is performing well over time, it's going to provide you with a great return on that investment.
Perfect. On the next slide, I'd like to read Warren Buffett's, "I make no attempt to forecast the market. My efforts are devoted to finding undervalued securities." So I think that mentality is more, you make your money when you buy. And then you, as Norena just threw into the conversation line there, you buy and hold. And the same thing that, again, applies to real estate, echoing what you're saying. And then Christopher Davis, another very good comment regarding timing the market. Let's go to the next slide and talking about balancing our portfolio. Asset allocation by age, if you're in your 20s, if you're in your 30s, the 50s aren't in there. I feel unrepresented by the graphic, but the 60s are in there, 60s, the 70s, and then 70s plus. So take us through this slide. Obviously, if it's Jerry
I think if you're in your 50s, you should just be out of the market altogether, Jerry, apparently.
Yeah, Jerry Jr. is in his 20s. I'm in my 50s. And if we have any people that are online right now that have parents or themselves that are in their 70s, how does this all play there? And how do you balance a portfolio? I would have no idea.
Well, it's just, it's a pretty simple formula, basically. And that is, the younger you are, the more that you should be in stocks, because those stocks are going to grow over a period of time, almost without exception. The older you are, then if there's, a setback in the market, if we have, a 6-month bull market or a 1-year bear market, or a 1-year bear market, it might come at a time when we really need that money, or we need it for retirement, or we need it to help offset our individual expenses. So the theory is, the younger you are, the more you should be in stocks. And the older you are, the more you should be in cash or other fixed income type investments, such as bonds.
Thank you. And Lucy Guzman, thank you for your comment that I am young. We're going to call it mature and experienced rather than old. Okay, Gary. So I go to my next slide, and this is my slide that's one of my favorite ones, because the idea today that I want to express to you is that investing in your future, everything starts with the very first step. And as my mentor Jim Rohn would say, the time to take action is when the idea is fresh, when the emotion is strong. The time to take action is today. So give me your thoughts on taking action today, Gary.
Yeah, it's kind of the approach that entrepreneurs, people give you advice as an entrepreneur, which is, a good idea today is better than a perfect idea tomorrow, which basically means the most important thing is to get started, right? And I say the same thing about investments. Don't, wait till you have this, all the research done and all the knowledge in place. And when, that could take, months, years, whatever the case may be. It's better to take baby steps first, and just get started, because that is going to be the most important thing that you can do for yourself and for your long-term plans, financial plans. So just get started.
And yes, Roseanne, a journey of 1,000,000 steps begins with the first and single
That's
step.
right.
You're
That's
absolutely
right.
right. As we go to the next slide, we want to let you know there is some recommended reading as a follow-up to that. The Automatic Millionaire is the book that I just read. As you remember, David Bach was a speaker at
And by the way,
NAHREP
Jerry, let me just interject real quick. David Bach is on contract with us for the balance of 2021, and he will be doing a series of web-based presentations for our members over the course of 2021. He's become a good friend of ours.
That's wonderful. And his ideas, I think, Gary, in my opinion, are simple. They're straightforward. They're very no nonsense, and they're very not get rich quick, but get rich the right way. And he makes it so accessible and paints a picture on how much easier it is to start in your 20s and 30s versus your 50s and 60s. But at the same time, mentioning that it's definitely not too late. Starting with paying yourself first, 10% of everything that you earn is yours to keep, and then making your investments automatic so that they're already on autopilot and that you are on your way to success and investing into the market. The other thing that we wanted, and before we open it up now for Q&A, if that's okay with you, Gary, we have a whole bunch of online resources that we're sharing here with you, where to get more information on general investing, where to get more information on retirement, on investment accounts, 401ks versus IRAs, traditionals versus Roth. I mean, there's a lot of information managing risk, choosing the investments, full service versus, limited service or no service at all, do-it-yourselfers, all these kind of things. So we're hoping that today, I mean, my vision, I invited my 3 kids to be on this webinar today. And I said, pay attention, guys. I want you to take baby steps. I want you to take a first step. I want you to invest whatever amount to just get you going, etc. Now, Adrian, of course, already bought 1 full share of Amazon stock. It must be all those boxes that are being dropped off at our front patio every day that inspired him to do that.
Why not?
But yeah, why not? Exactly. And then those should be for Jerry Jr. He has more boxes than Adrian, by the way. But I don't want to call him out here on a national webinar. But now let's go over to Q&A. Noelena and Jamie and Omar, where are our questions? And I've seen a lot of dialogue. I've seen a lot of great conversation over there. Would you want to throw us the first question, or where do we take a look at that?
By the way, Jerry, we should tell the folks that this deck will be available for them on our website.
At the NAHREP Hispanic Wealth Project side?
Yeah, I'm not sure exactly where, but it'll be on the NAHREP website as well as the HWP website. And I think Jamie will be able to respond to us as to exactly where that'll be.
And I invite you guys to have a great conversation with your kids about this. I just had it this week with my kids. I sat them down and I said, guys, let's talk about investment. Let's talk about money. And I looked at each one of them and I said, what have you guys done? That's when I learned that my son, Alex, was a little bit well-versed already, had downloaded Robinhood, some kind of an app like that, and had bought and sold little stocks and made a few bucks, lost a few bucks. And he thought, this is fun. It's kind of like gambling, Dad. You put some money in, it goes up, it goes down, you lose little, you make little. And he was looking at it almost like a game kind of situation. But it's a great time for you to have that dialogue and speak to your kids and talk to them about wealth and about investments. Okay, so what do we have here? Please put the questions in the chat box. Okay, let's see here.
Jerry, real quick, we can send an email out to everyone who participated in this webinar with this deck, and we will let you know when this will live on our website.
Excellent.
And by the way, where are they going to be able to do a replay of this program? Because I'm sure that there are a lot of people that are thinking this, such and such and such and such and such and such should have been watching this webinar today. So how can they replay it for them so that deck has context and has all of Gary's experience and wisdom?
Yes, it will be in the virtual event page.
Beautiful. Beautiful. Okay, so I guess we open up the Q&A box, Lucy, so we can see some of the questions here. And I'd love to shoot them out at El Jefe now that he's, okay. Where can we find our open questions, Noirena? I'm sure that there are some things that want to be covered.
If you go to the answered questions, there's been several questions that have been.
I see that you and Jamie have been answering them as they've gone along, which is great. So I think that made it even more efficient. But Jerry, let's just kind of wrap up by basically saying that one of the things that we're going to do beyond this presentation here is 2 things. We are going to set up a mastermind Facebook page, or what do they call those group pages?
A closed page.
Closed page where our members will be able to communicate with one another and exchange best practices around investing in stocks, bonds, index funds, and so forth. So we want to keep the dialogue going in that regard. And we don't want it just to be us talking to them. We want them to do some peer-to-peer communication about all of this. We got to start changing that paradigm in the way we talk about our investments and wealth building and becoming millionaires, frankly. I mean, that is, the objective. So that's number one. Number two is Morgan Stanley, our partner, will also be available to do these types of presentations to our individual chapters over the course of 2021, so that our chapters can share this information with their members, and it just becomes something that's readily available for all of them.
Got it. My last and final thought here, guys, is I go back to Gary's idea of being comfortable with saying, I have a net worth, a 7-figure net worth, or I am a millionaire. And I've shared this before in a smaller setting with NAHREP, where I've told people that the conversation I had with my wife saying, you know what, Mija, we need to go out and tell people how it is that, that we did it. We need to tell them that it's possible. We're very grateful, for our net worth today, etc. And she said, well, I'm not comfortable with you, using that word, the millionaire word, but you need to be comfortable. We're looking for 1,000 new Latino millionaires. We want you to raise your hand. There will be support, there will be education, there will be guidance, starting with this wonderful webinar that we shared today to get you started. The most important takeaway, in my opinion, is get started this week. Do something this week that puts you closer to whatever the overall goal is going to be. Would you agree with that, Gary?
Absolutely. Absolutely.
So do you want to close it off for us, Gary? Any final words? Where are we on that?
No, I think this is step one in really sort of realizing the vision that the board has for NAHREP in 2021 and beyond, which is NAHREP is the place where Latino practitioners come together, share best practices, acquire information about the goal of building long-term generational wealth for themselves and their families. This is what we're going to be known for. This is what our members are going to gain by participating in NAHREP. It's going to be a very, very exciting thing for us and our members.
Muchísimas gracias. Well, with that, we want to thank everyone that has joined us today, and we wish you lots of success. Look forward to having you connect. How would they find the Facebook close page? How would they be locating that? I mean,
that'll all be announced later, Jerry. So we're going to do formal announcements around that.
Beautiful. Bueno, pues entonces, muchísimas gracias, NAHREP familia. We hope that you've enjoyed today's webinar, and we hope that you share this webinar, replay it with your family, and receive that deck, study it, do an in-depth study, and make that first step. I, su hermano Gerardo Jerry Ascencio, would love to hear what your first step was. I'd love to see you walk your journey. I'd love to celebrate your success, big and small. And we'll see you at the top, being a millionaire and letting that roll off your tongue. Muchísimas gracias.